Today, we're breaking down one of the most striking divergences in the AI infrastructure space, Dell versus CoreWeave. On February 27, 2026, Dell Technologies jumped more than 21% after a blowout earnings report, closing at $148.08 with massive strength in AI server revenue. Meanwhile, CoreWeave dropped over 18%, closing at $79.56 as investors reacted to heavy capital spending and margin pressure. Two companies that are both important for AI. Two very different market reactions. Let's start with Dell. Dell is increasingly seen as one of the key picks and shovels providers for the enterprise AI boom. In its latest quarter, Dell reported revenue of $33.4 billion, up 39% year over year, and its AI server backlog topped $43 billion. Investors are impressed by three things. First, Dell is converting backlog into real revenue. Second, enterprise adoption of AI hardware is accelerating. Third, Dell is doing this without sacrificing margins, strong operating leverage. Based on discounted cash flow analysis, Dell's free cash flow strength supports a fair value in the mid-150s today, which aligns with consensus one-year targets between about $157 and $168. On the upside, if AI demand stays strong and multiples expand, some models suggest Dell could reach into the $200 range in the near term. Looking 5 years out, under reasonable growth scenarios and stable margins, DCF models suggest Dell could be in the mid-300s, in a range like $340 to $375 by 2031. If you use a multiples-based approach instead of DCF. For example, apply a higher earnings or free cash flow multiple due to sustained AI momentum, price targets can skew even higher. That's because higher multiples reflect increased investor confidence in Dell's long-term earnings power. Now let's shift to CoreWeave. CoreWeave built its reputation as a GPU-rich neocloud provider with early access to NVIDIA chips. Revenue has grown quickly, but heavy capital expenditure has squeezed margins and driven wider losses. That has created a current negative PE, reflecting the fact CoreWeave is still investing heavily in capacity. As a result, the one-year analyst target sits near $124.70, capturing near-term growth optimism. At the same time, many models show the 5-year price target dropping to something like $90 to $120. That's because long-term DCF models discount far-off profits heavily when growth slows and capital spending remains high. When you assume lower terminal growth and higher discount rates, long-term valuation can actually be lower than the near-term target. But let's talk about other valuation methods where CoreWeave price targets could be higher. One common alternative is a price-to-sales multiple model. If CoreWeave can maintain rapid revenue growth and preserve pricing power for GPU access, and if the industry assigns a higher sales multiple, say 8x to 10x revenue, then valuation results could be materially higher. Under those assumptions, 5-year price targets might rise toward $150 or more, especially if cloud revenues scale faster than expected. Another approach is a sum-of-the-parts valuation. In this method, you separately value CoreWeave's GPU hardware capacity, its contracted future revenue backlog, and its strategic data center footprint. If the industry places high strategic value on GPU capacity coming online near 2030, CoreWeave's value could again tilt higher than the straight DCF implies. Then there's the network value to revenue model, sometimes used for high-growth cloud platforms. In that case, if CoreWeave significantly expands its customer base and transitions from usage-based pricing to subscription contracts with sticky revenue, valuation multiples could expand, and with them longer-term price targets. So, yes, depending on the valuation method, CoreWeave's long-term price targets could be significantly higher than conservative DCF range. But those higher targets depend on execution, meaning scaling revenue faster than peers, managing capital spending, and improving margins. Now, let's recap the fundamental divergence we're seeing in the market. Dell represents a profitable AI infrastructure player with strong free cash flow, real backlog conversion, and expanding margins. That's why Dell gapped up sharply. CoreWeave represents rapid growth in a capital-intensive business. Heavy spending, competitive pressures from hyperscalers, and margin compression are what drove its stock lower in the short term. Both companies are critical to the broader AI ecosystem, but the market is rewarding cash generation and operational strength today, while applying skepticism to capital-intensive growth. If you found this breakdown valuable, thank you so much for watching. Please like this video and subscribe to the channel, and I'll see you in the next one.